Over a typical white-collar career, highly educated professionals in developed economies lose millions of dollars relative to the actual economic value they generate. Organizational economists rely on the 3 to 5x rule. Knowledge workers must generate 3 to 5 times their compensation in firm revenue to be profitable. Structural market mechanisms siphon away the vast majority of this wealth before it reaches a professional's bank account. Empirical data suggests that a white-collar professional starting at $75,000 today faces a nominal deficit of approximately $3.9 million over a 30-year career. 5 documented structural market failures mathematically guarantee this 7-figure gap, regardless of how well an individual negotiates or which degree they hold. Between 1948 and 1973, a post-war social contract ensured that professional real wages tracked marginal productivity. Corporate compensation packages included annual improvement factors, meaning salaries rose in lockstep with the value delivered to the firm. This chart from the Economic Policy Institute shows economy-wide productivity and median compensation rising together for 3 decades. These lines permanently diverged in 1979. Productivity continued to accelerate, while compensation for the typical worker flattened. Since 1979, productivity grew by 90%, while compensation grew by only 33%. This gap represents billions in professional productivity gains captured by capital owners rather than workers. The 1979 Volcker shock catalyzed this split. Federal Reserve Chairman Paul Volcker shifted monetary policy to prioritize crushing inflation through high interest rates, even at the cost of mass unemployment and weakened worker bargaining power. This era established Nehru as a central bank orthodoxy. Nehru is the theoretical unemployment rate below which inflation begins to rise. To maintain it, central banks preemptively cool the economy whenever labor markets tighten enough for workers to demand substantial raises. The American macroeconomic engine now operates to prevent wage growth, ensuring productivity gains bypass the professional class. In 1970, Milton Friedman introduced the doctrine of shareholder primacy. This shifted corporate focus to a singular fiduciary duty to maximize shareholder returns. Corporations shifted from retain and reinvest to downsize and distribute, utilizing SEC Rule 10b-18 to funnel productivity surplus into stock buybacks. SEC Rule 10b-18 is a regulation that provides companies with a safe harbor from liability for stock manipulation when they repurchase their own shares. While professional wages stagnated, executive pay exploded due to agency theory. Agency theory is an economic framework positing that the interests of corporate executives and shareholders must be aligned by tying executive wealth directly to stock performance. This dual-track system uses rigid salary benchmarking to cap professional pay at the market median, while providing the C-suite with unbounded upside tied to that same professional productivity. Modern corporate governance transforms your increased efficiency into executive stock appreciation. Specialized skill sets often fail to force competitive markets to pay professionals their true worth. Professionals frequently face monopsony conditions. Monopsony is a market state where a small number of buyers, the employers, dominate the market, allowing them to dictate lower prices for labor. The Department of Justice measures this concentration using the Herfindahl-Hirschman Index, or HHI, which sums the squared market shares of firms. Professional labor markets average an HHI of 4,378. 60% of professional labor markets exceed federal antitrust thresholds. An HHI of 4,378 is equivalent to a market with only 2.3 employers bidding for your specific expertise. Thin markets enable employer collusion. In 2015, court documents revealed that executives, including Steve Jobs, orchestrated secret no-poach agreements to prevent companies from recruiting each other's engineers, directly suppressing professional salaries. Deep specialization often traps professionals in highly concentrated markets, where a handful of firms dictate their earnings ceiling. Economists measure this power through marginal revenue product, or MRP, the actual dollar value one additional hour of your work adds to a firm's revenue. Monopsony power allows employers to apply a persistent 20 to 30% markdown on professional MRP. This means workers receive 70 to 80 cents for every dollar of marginal revenue they generate. This pervasive markdown broke Bowley's Law, the historical observation that labor's share of national income remains stable. Instead, labor's share of global GDP has dropped from 65% to 58% since the 1980s. This creates the superstar firm paradox. Globalization and technology allow superstar firms to dominate markets with extraordinary profit margins while distributing a historically low share of that value to their employees. A software engineer earning $300,000 at a superstar firm captures less than 20% of the $1.5 million in revenue they generate. In the 1980s, that capture rate would have been nearly double. High absolute salaries often mask the fact that professionals are capturing a historically small slice of the economic pie they produce. The $3.9 million career deficit is the product of the 1979 decoupling and the persistent monopsony markdown applied to your total value created. Generative AI, capable of producing content like text and code, now targets symbolic analysts once thought immune to automation, accelerating these suppression mechanisms. While AI can spike professional productivity by 40%, the intact architectures of shareholder primacy and monopsony suggest those gains will flow primarily to capital owners. Firms can now extract the output of multiple workers from a single AI-augmented professional without increasing their pay, while simultaneously freezing the hiring of their peers. This creates a bifurcation where a tiny elite of specialized AI architects commands massive premiums, while the broad middle tier of knowledge workers faces intensified wage compression. The $3.9 million gap represents the empirical baseline for a professional life in 2026. Navigating the next 30 years requires an objective understanding of the structural distance between the value you create and the compensation you capture.